the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. While Singapore shares opened slightly up today following the announcement of US President Donald Trump's global tariff rates. Now, Singapore is likely to remain at the 10% baseline rate, which Prime Minister Lawrence Wong said earlier was not ideal, but something the country can live with. So if you look at the Straits Times Index, it had a modest gain of 0.2% shortly after the market opened to reach 4,182.29 points. Now let's take you through the closing numbers. As we shared with you earlier, the STI ended in the red, down 0.48% at 4,153 points. In terms of value turnover, that's 1.66 billion Sing dollars. Gainers losers 244 versus 340. Top advances for today, we've got for you GMH USD, Neo Incorporation USD, and Oil Tech. And top decliners we have here Jardine, Cycle and Carriage, DBS, and Bukit Sembawang. Now, in terms of counters to watch, all eyes are on OCBC because OCBC's net profit for Q2 FY2025 fell 7% with the fall in interest rates, coming in at 1.82 billion Sing dollars for the 3 months ended June from 1.94 billion Sing dollars seen a year earlier. Now, elsewhere from how investors are reacting to new US tariff rates for imports from India, Taiwan, Thailand and South Korea to Apple forecasting revenue well above Wall Street's estimates overnight. We've got more international and corporate headlines in focus. And joining me on a Friday is Benjamin Goh, Head of Research and Investor Education at SIAS. Ben, welcome back on a Friday.
Hey, Dan, how's it going?
Good, but as usual, it seems like it's always very heavy on the news front. So let's start with global news this time around. US President Donald Trump, he signed an executive order imposing tariffs ranging from 10% to 41% on US imports from dozens of countries and foreign locations overnight. Now, just to give out some numbers, rates were set at 25% for India's US-bound export, 20% for Taiwan's, 19% for Thailand's, and 15% for South Korea's. How are global investors taking in the news thus far?
Well, not good, but quite a bit worse. If you look at US S&P 500 as well, Dow Jones Industrial Index futures, they're down about 0.9%. Quite a bit of a escalation since about 2-3 hours ago when it was down about 0.35%. So I think things could get, the future, at least on the derivative side, things could get worse as we head into the, evening open of the U.S. markets. If you look at European markets, the big two, French as well as German stock indices are both down about 1.7%, and the UK's FTSE is down about 0.64%. So on the whole, Europe's big caps index is down about 1.7%. Not unsurprising, simply because big caps tend to sell a lot of, generate a lot of revenue from their exports to the U.S. So the broad narrative is that the global markets have been a little bit skittish since the last, end of last week. So this is the sixth trading session when the, global markets are down. So despite blowout earnings from Microsoft and Meta, as well as solid numbers from, as you mentioned, Apple and Amazon, the tech rally obviously fizzled out. Now it's really very clearly a risk-off environment. So the good news is that the actual tariff rates are out. The bad news is that there's uncertainty regarding how the tariffs are going to be implemented, as well as the arbitrary nature of the tariffs, the number as well as, which countries are getting what, really giving rise to a little bit of policy uncertainty here. And of course, just to mix things up a bit, Trump has also sent letters to 17 of the world's largest pharmaceutical companies, asking them to lower drug prices. Although, it's said that the wording was quite harsh, but it wasn't a demand. It was more like an ask. So again, we're going to have a lot more volatility on that front heading into the weekend.
Okay, since you mentioned that, I do want to talk about how healthcare stocks dropped 1.3% after Trump sent letters to leaders of 17 major pharmaceutical companies that include your Novo Nordisk and your Sanofi. So Novo Nordisk earlier, it shed 4.2%, falling to an almost 3-year low. But, Ben, in the meantime, let's stay in Asia for now. Asian shares fell today. Any thoughts on regional movements?
Sure. Again, it's a question of how bad it could have gone. If you look at Korea's Kospi, it was down almost 4%, which, quite frankly, I've never seen 4% on the day-to-day trading before. Japan was a little bit muted, down about 0.66%. Hong Kong down 1%. China CSI 300 down about 0.5%. And as you mentioned, Singapore down also about 0.5%. So I would say that is not too bad, actually. And I guess the narrative behind this is that investors were already girding for the worst. So once the reality hits, it's like, okay, so we are over this hump. Let's get on to the next big thing. Which is obviously the U.S. tariffs on China has not been announced, has not been finalized. Again, there is going to be an extension for the, discussions to go through. What is, again, a little bit concerning is that any U.S. tariffs on China may actually lead to secondary tariffs on China from other countries, simply because if you take, for example, the EU, they are a little bit wary of China dumping its products in EU countries simply because they can no longer sell to the U.S. And, of course, the inflation concerns are still very much intact now that the numbers are in, and that's probably going to take center stage as well as the Fed policy in the second half. So don't expect volatility to ebb anytime soon.
Okay, we talked about Singapore in brief earlier. I do want to deep dive into local market movements today. I mean, if we look at Singapore, it's likely to remain at the 10% baseline rate, which PM Lawrence Wong said was not ideal. He said earlier wasn't ideal, but it's something that, we can live with. If we look at the STI, it saw a modest gain of 0.2% shortly after market opened, after, a 2.3% drop in 6 days from its record high. But as we shared earlier, the STI, back in the red at the close. So any thoughts on the movements today? Any surprises when it comes to the biggest movers as well?
Well, I guess today's numbers is testament to the fact that earnings do matter because the two biggest winners was Seatrium, up 1.32% on the back of really healthy first half results. And, of course, the company has also guided to a very healthy order book of 18.6 billion Sing dollars. And, of course, moreover, Seatrium, the stock price has been coming off a little bit since the beginning of the week. So, since the good numbers are out, it could be a case of investors buying the dip. And we also have got similar good buy from Jardine Madison Holdings, which is up 2.66%, which I think we're going to talk about later. Rounding out the advances today is UOB Group, SATS, Singtel, and SIA. Everybody else was in the red. Obviously, the banks were kind of, down about 0.6% more or less, simply because they are a barometer of the health of the economy as well as the global interest rate environment. So not really surprising as to, the type of counters, the names which are up today, and everybody else being in the red.
You talked about Seatrium, but I also want to talk about OCBC because OCBC's profit for Q2 FY2025 fell 7% with the fall in interest rates, and it came in at 1.82 billion Sing dollars for the 3 months ended June, down from 1.94 billion Sing dollars seen a year earlier. How would you read into the latest numbers, and how far will the remaining two of the trio of local banks track, the numbers that we saw with OCBC today?
Sure. Well, OCBC's net profit fell 7%, but actually the market expected an even worse result. So it was, bad, but not as bad as expected. So that's actually good. But of course, beating analyst expectations was not enough to stop investors from selling today, given the timing of the U.S. tariff bombshell. I think the other banks may probably perform similarly. So in respect of the net interest margin being under similar pressure. But again, all three banks have got very similar geographical footprint as well as business models. So as you can see, OCBC's results were actually supported by the growth in the wealth management area. So I would expect the other two banks to perform similarly. in that any kind of weakness in the net interest margin should be mitigated to some extent by growth in corporate lending as well as rather stable performance in net interest income, especially the bank's wealth management divisions. Now, going forward, again, as I alluded to just now, the three local banks, especially DBS, has got a rather large geographical footprint in Greater China. If memory serves me right, they do quite a lot of business with the state-owned enterprises in China. So any kind of impact of U.S. tariffs on China, on Singapore's trading partners, especially China, is probably going to be an ongoing risk for the three big banks.
Okay. Now, if you're just tuning in, we're now in conversation with Benjamin Goh, Head of Research and Investor Education at SIAS. Ben, another counter to watch, you talked about it earlier as well, Jardine Matheson Holdings, because Jardine Matheson Holdings reported yesterday this 45% growth in underlying profit for the first half of FY2025 to $798 million US, and that is from $550 million US seen in the year-ago period. How far were the numbers in line with your expectations, given what we saw with Jardine Cycle and Carriage earlier this week?
Well, sure. So, Jardine Matheson Holdings actually beat consensus analyst estimates on both the top line, the revenue, as well as on the earnings per share basis. Yes, there was underperformance in one of the subsidiaries, Jardine Cycle and Carriage, which, by the way, is 85% owned by Jardine Matheson Holdings. But that weakness was more than offset by other companies in Jardine Matheson's portfolio. So, for example, you've got Hong Kong Land. Hong Kong Land generated $810 million US from the sale of office floors. You have DFI Retail sold stakes in Yonghui as well as Robinson's Retail. DFI Retail also announced a special dividend, which obviously going to benefit Jardine Matheson. And Jardine Matheson has already announced that it's going to use that special dividend to reduce its debt burden. So from a net perspective, the market analysts actually do like this company quite a fair bit. Goldman as well as CD Group both have got buy recommendations. The only problem here is that the stock price has already moved up quite a fair bit, so any kind of upside potential vis-a-vis the consensus target price might actually be quite limited.
Okay. And from GMH, Ben, let's talk about Apple. Apple forecast revenue for the current quarter ending September well above Wall Street's estimates overnight, sending shares up despite a warning from CEO Tim Cook that U.S. tariffs that would add $1.1 billion US in costs over the period. Brighter days ahead for Apple, you'd think, given some form of, I'm not sure if you can call it certainty from Trump's tariff announcements.
Yep. I think it's a definite maybe on better days. Okay, so let's look at it, right? I think some of the revenue numbers was probably front-loaded, by clients, by customers, just so to dodge U.S. tariffs on both India and China. But apart from that, if you zoom out, Apple actually has got very specific structural challenges. So again, coming back to India and China, right? So Apple is, trying to ramp up production in India to be less dependent on China, but U.S. tariffs now 25% on India. And of course, we don't know what kind of tariff rate is going to be, applied to China itself. So already that may be a problem for Apple. Apart from that, you have got the Trump administration, which is putting a lot of pressure on Tim Cook to move quite a fair bit of his production back to the U.S. And of course, based on anecdotal news feed, the production cost of an Apple iPhone Pro might actually cost like $2,000 US if they were to make it in the US, of course, wiping out any kind of profit for Apple. Yeah. Then, of course, you've got the other thing, which is the whole AI fad. Apple is, to be quite honest, is MIA. So it's got challenges building up its AI capabilities. I think it's Apple Siri, right? It's still based on existing tech. It does not, they've got some challenges in embedding Gen AI into it, so on and so forth. And I think, again, based on anecdotal news feed, they are actually losing AI talent to their rivals. So all that said, Apple has got specific structural challenges, but again, this is not new territory for Apple. I mean, they are, very well-run company. And the consensus analyst target price is still actually very bullish. So I've seen, estimates anywhere from $210 US per share to as high as $275 per share, and the current Apple price, I think, 208. So there appears to be a little bit more upside potential compared to the challenges the company actually faces.
And finally, before I let you go, Ben, all eyes on the U.S. July's non-farm payrolls report. I believe the consensus is for non-farm payrolls to have increased by anyway, I've seen 100,000. I've also seen 110,000. So what are you expecting for the time being, and what are the odds of a surprise on the upside?
I think there's probably a slightly better and even chance of an upside surprise. I mean, based on historical data, right? And again, as you have alluded to, the numbers are all over the shop. I've seen forecasts as high as 160,000, new jobs created. So that's all and good. So long as the number is somewhere around consensus or slightly higher, that'll be great. But the other number that we should be paying attention to, and again, this was highlighted by Jerome Powell, was the unemployment rate. So the U.S. unemployment rate currently stands at 4.1%, and the consensus estimate is for 4.2% for the July print. Now, the challenge, of course, is that the market is already at a nice edge, so any kind of negative surprise, if the unemployment rate goes up above 4.2%, then obviously it was a very smart idea for most of us to kind of par down our positions heading into the weekend. So fingers crossed that we get a pleasant surprise in the weekend on this front. But I guess anything goes nowadays, I suppose.
All right, thanks so much for the insights, Ben. That was Benjamin Goh, Head of Research and Investor Education at SIAS. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.